A founder secures $200,000 in funding. The hard part is over, right? She can finally breathe. 8 months later, she's out of cash. Not because the business failed, but because she never tracked where the money was actually going. Getting funded is a milestone, but it's actually not the finish line, it's the starting gun. Today, I'm going to show you how to manage your funding so it actually fuels your growth instead of running dry when you need it most. Here's what we're covering: why use of funds reporting matters and what it actually means. We're also going to help you compare your forecast to the reality so you can catch problems earlier. You're going to learn how to track your cash runway so you're never caught off guard. You're going to learn best practices for keeping stakeholders informed and confident. And you're also going to learn why funding can be cyclical, and when it is, you're going to be able to manage it and set yourself up for getting more cash later. When you pitched for funding, you told investors or lenders exactly how you'd use the money: payroll, marketing, equipment, whatever you needed. But here's what happens. The money hits your account, things get busy, and suddenly you're spending reactively instead of proactively. Use of funds reporting is simply tracking how you're actually spending that money compared to what you said you'd do. This keeps your strategy on track. It helps you avoid cash surprises and keeps your stakeholders confident. We all want that. It's not just administrative, it's actually how you stay in control. Your business plan was built on forecasts, educated guesses about revenue, expenses, cash flow, but now you have real numbers. The problem is most founders create a plan to get funded, but then they never look at it again. The key here is to compare your forecast to actuals every single month. Are expenses higher than expected? Are your sales slower? Where's your cash balance compared to your plan? This regular check helps you catch small discrepancies before they can become a cash crunch. Comparing forecast to actuals, it sounds simple, but it can get messy fast if you're doing it manually. That's why we built LivePlan. It connects to your accounting software and automatically compares your plan to what's actually happening. So you can see those variances and instantly adjust before small problems become big ones. Right now, you can get 50% off your first month. The link's in the description. All right, so let's talk about adjusting your forecasts and watching that runway. Once you see how reality compares to your plan, the next step is to actually update your forecast. Too many founders keep operating off outdated assumptions. That's how you end up surprised. Revise your projections to reflect your current trajectory. Then calculate your cash runway. How long will your current funds last before you need more revenue or maybe even new financing? Tracking this monthly keeps you from the worst scenario, finding out you're out of cash when you're already out of cash. Once you see where funding is actually going, it's time to update your milestones. Maybe break even is further out than you planned. Maybe a marketing channel is outperforming everything else. Use that insight, refine your plan, reallocate funds towards what's working, right? Don't spend money where it's not working. Your business plan should be a living document, not something you filed away after getting funded. Let me give you a few tactical habits that keep businesses solvent. Track spending diligently. Categorize expenses so you know exactly where each dollar is going. Avoid taking on more debt unless necessary, but don't ignore cash flow problems either. Communicate with your lenders or your investors. If you need to adjust terms or shift strategy, tell them early. They'll trust you more. And if you end up with extra cash, pay down that expensive debt before taking on new spending. Even if your lender doesn't require formal reports, keeping records is invaluable. You never know when they might ask for them. For investors, reporting is usually more formal. Monthly financials, cash flow projections, P&L updates, clear explanations of any strategy changes. Transparency is going to build trust, and trust opens the door for future funding. Here's something to keep in mind. Getting funded once doesn't mean you're done. Many businesses go back for more, for growth, for unexpected challenges, new opportunities. By mastering how you manage and report funding now, you're gonna set yourself up for better terms and more capital later, if you need it. You also start to understand what kind of funding actually fits your business best. Investment, line of credit, debt. And when that next round comes, don't overlook grants. They're essentially free money. No equity, no repayment. We've compiled a small business grants directory with opportunities that you can apply for right now. Grab it from the link in the description. Managing your funding isn't bookkeeping. It's a strategic habit that keeps your business growing. Compare your forecasts to reality, right? That's where you're living. Adjust when things change. Watch your cash runway and communicate with your stakeholders. So what are you gonna do? You're gonna track it, adjust it, report it, and grow with confidence.